guys, Tyler here. In this video, we're going to be talking about the 3 simple techniques that I use to determine my bias for an individual trading day. I'm going to show you the 3 things that I use, how you can use them to help you more simply identify which way price potentially could run. So let's go ahead and get started and check out the charts. Number 1 on the list is to identify the draw on liquidity. Where does price want to go? Where are buy stops or sell stops potentially sitting that price may want to run to grab that liquidity? Price only runs for 2 reasons. It's either to grab liquidity or to rebalance or balance inefficiencies that are in price. So when we're looking at this chart right here, I'm looking currently at a daily. But when I want to find the draw on liquidity, I will always start on a higher time frame. We'll look at the weekly. Well, yesterday price hit all-time highs. We see all-time highs hit right there. So from a weekly standpoint, could price go higher? Yes. Could price go lower? Yes. So we really don't have a clarity on drawing liquidity from the weekly. When that happens, we drop down to the daily, or we drop down to a lower time frame. So when we look at this candle that hit all-time highs yesterday, we know that price could either go higher or lower. Now, for us to determine if price wants to go higher or lower, that leads us into our second thing that we use to determine our bias for the day. And that is using PD arrays and fair value gaps, more specifically, to help us determine a draw on liquidity when looking at a higher time frame. In this case, we have a nice big draw on liquidity right here, in the form of a fair value gap on the daily time frame. Anytime you have a high and a low not touching with a candle in between, that creates a fair value gap. And this is a buy side imbalance, sell side inefficiency. So that means the sell side has not been delivered to it. We've had buy side delivery in the form of this green candle, but we have not had a red candle come back down into this area, making it a fair value for price to move to. So when we have a large daily fair value gap, that is a very good point of interest. Now, you can't just say, well, okay, we're going down into the fair value gap. We need to know how we're going to actually get there. And that is where we use our third simple technique to actually get there. But before we go over that, let's bring this down. So here we are looking at the 15-minute time frame. This black line is all-time highs, and this green box is the daily fair value gap. Now, as we see price has come up here and made its all-time high, and then into the close of yesterday, we retraced. And over the London session and Asia session, we basically consolidated. In the London session, we hit a low, and now we're coming up, and it is now 9 a.m. or 9:15 before the open. Before the open, is price going to go up or down? Now, obviously, we know it's going down, but I'm going to show you how you can reasonably determine that it's going to go lower and make a plan around that idea. Price could go down into this daily time frame at some point. However, when you're at all-time highs, you really never want to fade all-time high scenarios, because we could just go higher and higher and higher. And people try to fade the idea of all-time highs, and then they get burned. So how can we reasonably determine that? Well, we have to go up into a slightly higher time frame and begin to look at additional PD arrays, okay? So if we look here, we are going to have a trend line on the 1 hour that shows up beautifully. This is in the form of a breaker. Now we see this actually form before the market open, where we see this high, these highs, a low, and a higher high. And then we see price break down below that, where we want to start watching this level right here. Now, it could be a breaker, it could be a mitigation block, it could be a fair value gap. We are trying to determine how is price going to get down into this fair value gap. It's such a large space. So we need to use other PD arrays that's going to support price moving lower. Now, how do we know what PD arrays to use? This is where we go into number 3 of the simple techniques to determine your bias, and that is using premium and discount. This right here is the low and the high of the most recent leg higher that made the all-time highs. So from this low to this high, we pull a Fibonacci tool and we find out what the 50% mark is from the low to the high. What is that 50%? We call this equilibrium. If price wants to move higher, which it could, I don't want to be involved unless price comes all the way down to the 50% mark. This is a reasonable place for you to go long. Why? Because below 50% is discount. Above 50% is premium. Anytime you're in a premium environment, you want to look to go short. Anytime you're in a discount scenario, you want to look at going long. Well, all of this price action is in the premium area of this leg. And what do we have in the premium area? We have another PD array, another bearish PD array that supports the idea that price wants to move lower. We also have another PD array in the form of a fair value gap that supports the idea that price wants to move lower. You might look, well, we went into this fair value gap right here at 4 a.m. Well, one of the things ICT teaches is that you will want to see price move down into that fair value gap in the normal trading hours. That's between 9:30 and 4 p.m. If it does it in the pre-market and post-market hours, you can expect that price during the normal regular trading hours will still go down into that. So if I mark out the opening price as I have right here, the only time we've entered into this fair value gap was in the pre-market. We have yet to actually balance this area within the daily fair value gap. So when we see price come up right here and hit a bearish breaker, this gives us an idea that price could move lower. In addition, we're also sitting in that premium area, which when we're in premium, we want to go short. When we're in discount, we want to go long. So let's recap the three things that we look for when we're trying to determine our bias. Number one, we need to find the draw on liquidity. We start at higher time frames and begin moving to lower time frames to trying to figure out, could price go lower or higher? What's the closest draw on liquidity? In this case, we had the all-time highs and we had a fair value gap that price could want to rebalance to. It could do either. So because it has the potential for doing either, we need to look and add our second simple technique, and that is looking for PD arrays that support price for moving lower or higher. Well, we have a bearish breaker right here showing that price could want and could move lower. At this point in time, we really didn't have any bullish PD arrays that supported price moving higher other than we're at all-time highs. When you're at all-time highs, you assume price wants to go higher. The third thing is looking at premium and discount. Because we were sitting in this premium environment and we had yet to reach down into discount, even if we turned and we ran for all-time highs, you as a trader should not and would not want to participate in that move because it's unpredictable. We want to wait for price to move down to discount. When price moves down into discount or below this 50%, we can now reasonably plan or look for opportunities to go long to reach those all-time highs again. But because we weren't and we were sitting in this premium environment, we just now have an idea for our bias for the day. Now you take the same process in all different scenarios and you're going to come out with the same answer. It's either going to be wait for more information, or I have a target and now I need to begin to look for my model to show up in price action so I can go short. Let's go down to the 5-minute time frame. Here we are, pre-market, we hit that bullish 1-hour breaker. We came down, we did not take out these lows, and we came back up. What's interesting right here is our breaker for our entry. And this is where we would be waiting until price hit these levels. And look what it gave us. We have a high, a low, into a fair value gap, a higher high with a wick, and price moved lower. We have our first entry opportunity right here. We have our second entry opportunity right here with a big move lower. And then we have a third opportunity for an entry with an even bigger move lower. So this is to give you an idea of how you can determine your bias. If you like videos like this, where I break down how to read markets from higher time frames down to lower time frames, consider liking, subscribing. Thanks for watching, guys. We'll see you in the next video. Take care.